Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, on the heels of the Dow's first 4-week stretch of positive weeks since the period ending October 12th of 2007, and as we begin the first quarter earnings season, is the bottom in, or do we have yet another serious down leg left to this stock market? We're going to ask Editor-at-Large Steve Reitmeister, Senior Market Analyst Charles Rotblatt, and Top Technical Analyst Kevin Matris what they think here at this edition of the Roundtable. I don't mean to sound, so naive. It's like, well, how did we get this far, or how did we get to this place in time? But it's an impressive run in the Dow. It's more than 20% over the past 4 weeks. So how did we get here?
Right. Yeah, it's an impressive run, and I think far too many people are thinking this is absolutely the sign that bottom has been put in. And I would definitely put up a sign of caution. There was 6 such rallies of this size, in the early 1930s, following the big crash of the market. And so I would just say, proceed with caution. But how we got here is, first you get into oversold conditions. Okay, so the market really raced down into the mid 6,000s on the Dow with very little resistance, and so there's always going to be a little bit of a pop, and that pop can happen quite fast. And I think it was like it went up 6% in the first day that after it hit bottom. And it can rally very fast. And I think most everyone that I know just thought of that as, here again, just oversold conditions. That doesn't mean anything. We're probably going to be retesting again. But then the government started to have a goodwill tour. Okay, they started to get their act together, and it was like one thing after the other. So Bernanke goes on 60 Minutes, and Geithner starts getting his act together and doesn't look so pathetic. Like, I really don't have a plan, as was the first go around. And Obama's picking up strength in his speeches. So the three of them in concert. And then you have the $1 trillion bond buyback program. And then you have here Geithner's plan for how to gobble up the troubled assets. And it's all kind of coming together. So what you had was oversold conditions, just a little bit of a bounce. But then it seemed to pick up a little bit of reality. You know what? Maybe they do have their act together. Maybe it could be better than we think. And so that's how we kind of got to this precipice of where we are right now. And really, we've been talking amongst ourselves here. This is kind of a breaking point. We could see a case where we just kind of sit here for a while, like we've gobbled up enough already. Let's see for signs. And could also be a case that we just continue to rally from here, just on here again this goodwill tour. It's a tricky spot.
So, Charles, if we had to liken this to a ball game, can you tell us what inning are we that we're in? Is this recovery, or is this a bear market rally?
A little reference to the opening day that won't be happening.
Postponed, yes.
It won't be happening here in Chicago.
Yes.
No delay.
But, I think we're maybe in the second or third inning. We've got a long way to go. And, a lot of talk has been on the Geithner plan, on some of the things the government's goodwill, but there's also been some changes in the undercurrents that haven't got as much notice. Specifically, when you look at economic data, in the fall we had this very rapid pace of deterioration, and now it's slowed. To use a skiing analogy, we've really gone from a double black diamond to a bunny slope. But I understand the trend is still downward, and the economy is still worsening. But unemployment's averaged about, the drop in non-farm payrolls has averaged about 660,000 since November. The ISM's flattened in the upper 30s. Leading indicators is kind of flattened. They're all showing further worsening of economic conditions, but you're not seeing the huge drops we saw in the fall. The other thing is, when we look at the banks, back in February, we were seeing 8 estimate cuts for every positive revision. That number's improved to 5 cuts for every positive revision. Still negative, but not as negative. And I think that's actually helped stocks at least get a temporary lift right now.
Not as negative maybe because analysts have low expectations anyway?
Well, I think so, but I think they're also looking at the pace of deterioration and realizing that maybe some of the worst is beyond us. But also, when you look at banks, we are seeing the Fed step up. You are seeing the banks saying, you know what, with this free money we're getting, we're going to post an operating profit. But I think a lot of people are looking and trying to realize that maybe the absolute worst has actually happened, and although things could still deteriorate, we're not going to see the rapid pace that we saw in the fall. I think the initial shock value of everything's over with.
Kevin, is the bottom in? Could the unprecedented federal intervention that Steve talked about a little while ago, could this shorten the downturn?
Very well could be. I'm going to keep my comment short, only because they're going to almost perfectly mirror what Steve has said. But yeah, I do want to say the move that we had seen has been extremely impressive. The Dow was up over 24% in 4 weeks, S&P up over 26, NASDAQ up over 28. And again, I think one of the things that precipitated this rally was that we were grossly oversold. And as Steve had said, the down move that preceded this was just as sharp. It happened over just as short of a period of time. So what's interesting is that while this move has been pretty spectacular, all we really did was get back to where we were before this dump had taken place. And also, as Steve had said, I think that you had a lot of things come together. There was a whole confluence of good news, if you will. You did have the second stimulus. You had the plan to buy up the toxic assets, which I think was a good idea. You had the Treasury coming in to buy treasuries. You got the PPIP plan, which was finally unveiled by Geithner. Everybody's giving him a break to see what happens. And we actually saw some decent earnings. Now, I know earnings season starts with a vengeance this week, but yeah, we had many companies come out with halfway decent numbers. They came out with decent guidance. And I really think the market is kind of in a, hey, let's see if all of this stuff works mode. And I think that is where we are right now.
So, Charles, I'm hearing a lot of folks out there saying that the proof to whether or not this rally can continue in the stock market is going to hinge largely on first quarter earnings and what they're showing.
You know, I don't really think it'll be first quarter earnings so much. Certainly, if the numbers are not as bad as feared, that'll help. But I think the bigger thing is when you kind of look beyond first quarter earnings season, and there's really two factors that still scare the bejeevies out of me.
Okay.
And that's a technical term.
Yes.
But first of all is GM. We got to watch that June 1st deadline. The new CEO's already mentioning about preparing for the possibility of bankruptcy. We don't know how it's going to play out. If bankruptcy occurs, what's that going to mean for the entire automotive sector? I heard one of the people from Ford last week saying that it could cause a massive disruption, not only for GM, but for Ford, for Toyota, for Honda, across the automotive sector. The second thing is with these banks, we've had a lot of enthusiasm over the banks. We've seen Citigroup almost triple in value. And the reality is nobody knows if those private investors are going to emerge to buy the troubled assets. And even if they do emerge, are they going to offer a price that banks really want? And I think last week's FASB's ruling, which modifies mark-to-market accounting, only complicates matters and may create a situation where banks are trying to create artificially high values for their troubled assets. Private investors might look at it, they might balk, in which case we could be kind of back to square one with this whole legacy asset problem.
So based on your concerns, where do you see the market going here in the next 3 to 6 months?
I think we're going to get a pullback from these current levels, possibly retest the lows we saw earlier in early March before this rally. I don't think the current rally is sustainable. Doesn't mean it can't go higher from here, because certainly the market can stay irrational longer than anybody can stay solvent. But I do think we're going to get a pullback, and a pretty sharp pullback, probably before the summer ends.
You guys agree with that?
I can make a case for one or two things happening. Right. You could make the case that the earnings reports are going to come out. What's interesting is that what we normally think of as the pre-announcement season, when the bad news gets flushed out, there was virtually none. Okay, so that's an interesting sign that the numbers will not be worse than expected. But here again, it doesn't matter what the earnings reports are for the first quarter. What matters is their statements about what they're seeing in current business conditions looking forward. Because everyone's already discounted what's already happened. They're looking forward, where's the turnaround? And so it's the statements of the current business conditions as they take a look at the early April numbers and what they provide as guidance for the second quarter. So I think that's going to be much more telling about where the market heads. But here again, I could see there's a good reason for the market to pause right here. Okay, it has eaten up enough. The market, I would by no means call it a screaming buy anymore, as it perhaps was 20 points ago, 20 percentage points ago. If the future guidance is solid, if there's no more bad news, you could get around where we make it to 9,000, no sweat, because people are starting to think, maybe I should get back in this market, right. And there's a lot of cash on the sidelines, so you could just run up there really easily. I could make a case that if there's continued bad news, and an interesting report this morning is the analyst's name is Mayo out of Deutsche Bank. He essentially did an assessment of the entire financial industry. He says, too little, too late, it's still toast, these are all sells. Now, this is somebody who knows, okay? The rest of us are guessing, okay? This is somebody who actually understands this business from the inside, and that was a very telling report that he just put out. And I got to put a little weight into that. And so there's your case for we've eaten up enough for right now. Let's give it 3 months in a trading range, see what we really got, and maybe indeed retesting.
This morning is April the 6th, by the way, if you're watching the calendar. What do you think, Evan? Are the technicals telling you something different from what these guys are saying?
You know, if you do look at the technicals, I'm not sure about today, but I know it was above the short-term moving averages, 10-day moving average, 20-day moving average, 50-day moving average. We are quite a ways away from that 200-day moving average. And again, that is basically like a moving trend line. So even if this thing did go higher, we could probably go all the way up to like right around 9,000, and the longer-term trend would still be, downtrend would still be intact. But what's interesting, and what I'm really hoping, it would be great to see the market consolidate these recent gains. And if we were to go down 20, 30% or so, I think that would be great. What's interesting is the longer we can base here, the bigger launching pad it could be for a move to the upside. The one thing, though, that I have noticed is that when you look at that recent dump that we had seen, actually the previous dumps that would take us to these newer lows, I mean, it really was like raining knives. There was almost no good place to hide. And I think the rally that we have seen, there was a lot of good companies, I've said this before, a lot of deserving companies having value put back in. What's interesting too, though, is that a lot of junk had gone up as well. So I think while the market digests everything that's happening, waiting for new news from the administration, waiting for new news out of these companies, I think the star companies, the outperformers, ones with good fundamentals, those should be able to keep themselves intact the most. But a lot of the junk that went up because of a rising tide raising all ships, those are the ones that are going to get punished. And I think there's going to be a great trading opportunity from this point forward.
All right, that's the latest thinking, the latest conversation from the folks here at the round table. And with everyone here, I'm Terry Ruffalo.